let me walk you through the psychology of support and resistance. Let's try and understand one thing. Let me take you to a new page. Let me draw an example where the stock price is coming down. And we see a chart that twice the stock had bounced back from 100. And we tell ourselves that this stock has a support at 100. Now, two types of traders are always there in the market. One who's a buyer and the other one who's a seller. So, as I was saying that two types of traders will be here at this juncture. One who will be willing to buy and the other person who will be willing to sell. Now, two persons probably looking at the same chart, one will say, well, the level of 100 is holding really well and I should be looking to buy next time when it comes to 100 and holds above 100. So he has a bullish view. On the other hand, the other person who's looking at this chart and he sees that this stock has corrected from 200 to 100 and it's in a very, very weak trend, he has a bearish view and he decides that if 100 breaches, then I will go short, I will sell it. So one person has looking into the same chart, creates a bullish view and waits to buy close to the 100 level. The other person looking into the same chart believes that the chart will fall further and he has a bearish view. It's completely all right. Now what happens? If stock comes down close to 100, the bull trader, he adds here, he buys on the anticipation that the stock will bounce back. Let's say it bounced back a little bit, but then eventually it breaks the support. The moment it breaks 100, the support, the bear trade is activated and he shorts, he sells. Let's say the bearish view goes right with the trend and it comes down to, let's say, 95. And if it falls further, let's say comes down to 93 or 92. Now at 93, 92, the person who bought is not very happy at all. But on the other hand, the person who shorted is actually making a quick buck because he got his analysis, research and trade right. What the bullish guy will do here, because he has gone wrong, at 93, he will use what is known as averaging out. So what he will say is, okay, I bought at 100, let me buy some more at 92, 93. It will take my average costing down. And if I get a bounce back, I can book out. So the person who was bullish, who bought at 100, at 93, he buys again. The one who was bearish and who shorted the stock and his view was right and he's sitting on a nice quick profit, he will decide that this is a nice place to book some profits. So what he will do, the person who was bearish will also buy. So at a lower level, both the parties infuse buying, demand. One buying is buying its original position, averaging out its original position, and the other buying is covering its erstwhile shorts. Because of this, we generally, you will notice, because of this, bounce backs are very sharp in nature. So the stock bounces back. Now, if this stock bounces back further and comes close to that 100 mark again, what will be the bullish guy think? He went wrong in the first instance when he bought at 100. It fell to 93. He did some daring and he averaged out at 93. Probably his costing came down to 96 and a half, 97 and a half, depending on the quantity that he buys. And the stock goes back to the level of 100. what he will essentially do is, as because he went wrong, he will take out his marginal profits or cost to cost, and he will exit. He will sell, get out of it, because that was his objective, to take the cost down, use a bounce back to exit. On the other hand, the bearish guy who went right, his research analysis was right, his trade gave him some quick profits. He finds that the stock is back to that level where he had earlier shorted and made some money. So his view of bearishness will continue, and he will also infuse some selling. So both the parties, when they started with a differing view, now shares the same view, and the stock corrects down. So moral of the story over here is, if you notice, earlier it was a valid support. The 100 was a valid support. By valid support, I mean that multiple times tested. At least 2 times. So one cannot hold. So at least twice. So when we see a price bouncing back from a level at least twice, we say that it's a decent support. The more number of tests, the better the support. And once this support is broken confidently, comfortably, and if prices come back to those levels, the support changes its behavior and becomes resistance. This switch of nature from a support, it changes its nature and it becomes resistance, and vice versa. Once a resistance is broken, it again changes its nature and becomes support. This shift is called the polarity, the principle of polarity. This is very useful. You will find it all over the charts. I'll take you to some practical charts and will show you how this works. But remember one thing, once you spot a valid support or a valid resistance, valid means more than twice test of that level. And if that level is eventually broken in the future, then quickly it will reverse its nature. From a zone of buying, it will become a zone of selling, and vice versa. This principle is called polarity. Now, before I take you to charts and show you this concept further, just remember one thing, that supports and resistance may not always be horizontal. This example, you would have noticed that the support line or the resistance line, let's say, wait 1 minute. Let's say this is a level where the stock goes, corrects, goes, corrects, goes, corrects. I can clearly see that this is a resistance. And if finally this resistance is breached, this support, this resistance will change its nature and become support. And it will give you support like this. Now notice that this line was horizontal. This support as well as resistance line, the slope was essentially flat, it's horizontal. That may not always be the case. You might have instances where the lines are maybe rising or the lines may be falling. So you can have instances where the stock finds resistance twice, thrice, and when finally it breaks, it will try to find some support. And vice versa, it can be other way around, where let's say the stock is giving some resistance, and once it breaks down, it will tend to give you once, twice, thrice support. This is on a rising, falling, and it can happen the other way around also. That earlier it was giving support, then it gives resistance. Both these examples are first resistance and then support. Support giving resistance. Let me quickly keep it in this because I'm drawing them, so it's better that I keep it in this page itself. So what will happen? Prices comes and finds some support, comes back and finds some support. So every time it's giving support, the support is breached, broken. Every time it bounces back now, it will try to find some resistance.